And thanks for joining us. I'm Marlon Bowling with you on a Monday as we sort out your ag trade for you with a little extra expert help along the way. Well, this time around we have BrianSplitt on the line. He's from Allendale Incorporated in McHenry, Illinois. And Brian, always a pleasure to visit with you. Thank you so much. Let's take a look at some numbers that came out from USDA this morning. We had export sales announced this morning before the markets opened up. It was a batch of corn, and if I'm doing my math right, this would be roughly about 2 of those Panamax vessels full, I do believe. It was sold to unknown destinations, 130,000 metric tons. So on the surface, that would be very bullish for the corn, you would think. And the corn, once again, did not respond. This is at least 2 or 3 weeks of this where you can have an overnight export sale and the market doesn't do anything. Let's take a look at the corn futures right now and see just what the case is. On December corn, wow, 3/4 higher at 349, and March 3/4 higher at 362 3/4. You were telling me right before we came on the air live that this is really frustrating for brokers when you can't get the markets to move. That's how they make a living.
It is. We just have a really a complete lack of volatility right now. The option market is showing that option values are down substantially year over year, with futures just about the same prices as they were last year. And that's using the March contract as kind of the baseline right now for option values. But you know, as far as exports, we did have a sale. You know, it's not a large sale, and you know, if you look at the overall corn scenario right now, USDA has a export goal of 1.85 billion bushels, which would be 6.2% over the 5-year average. So far, we've sold 670 million bushels of corn. That is 1% under the 5-year average. So, you know, we're running behind pace. You know, as far as the soybean sales are going, USDA has a 2.25 billion bushel export goal. That would be a new record. That would be 26% over the 5-year average and 3.5% over last year. You know, we're quite a bit away from that right now. We're at 1.116 billion bushels. That's 1% under the 5-year average and 10% under last year at this time. So overall, the pace that we're on right now is not the pace we need to be running at to hit USDA's target. Now, there's a lot of marketing year left, but as far as where we're at right now, it does not paint a bullish picture.
January soybeans right now are quoted a nickel higher at 9.91 3/4 per bushel. So, hey, they're within a tick of their high of the day at this point. About 7 cents off our earlier low from this morning. And if you look at the wheat trade, let's cover Chicago wheat first. December is 3 higher at 428 3/4. On the Kansas City market, we have December currently trading about 429 1/4. That would be up 2.5 cents on the day. And in the Minneapolis spring wheat market, December quoted at 628 3/4, so it is up 4 cents on the day. Looks like a definite firmer tone here on the wheat markets, that's for sure.
Yeah, and you know, actually, out of the grains that we're watching here, and you know, we had the export inspections out this morning. Just year over year, wheat is doing the best versus last year. Wheat is at 94% of what was inspected for export versus last year. Soybeans second at 91%, and then you have corn at only 54% versus last year's number for the same time of the year. So, you know, the corn market right now, we need to get some business going. We did have a very large sale to Mexico. That was done last week, so that's good to see, but we need to see more business like that.
All right, I want to take a peek here at the cotton market, too, while I have you here in this crop segment here. We have the December contract, 22 points lower right now. We are trading at 68.50 cents per pound. Brian, I'll bring you back here in a moment, and we'll discuss our livestock trade. We're talking with BrianSplitt of Allendale. You don't want to miss it. We're coming back after this. BrianSplitt is with Allendale Incorporated in McHenry, Illinois. He joins us right now, and I want to focus on the livestock segment in this particular talk here. And Brian, thank you for being a part of the show here. Always look forward to talking with you and get your insight into the markets here. We have had some interesting trade in the cattle market here over the past week or so, where it keeps going up, bumping against overhead resistance. In some cases, it will do a reversal out. Technicians and analysts think the high may be in, and then it comes back a day or so later, takes it out, and then blows on through. And then, of course, Friday afternoon, we had the live cattle on February closing limit up. So that now means expanded limit mode today. However, we have been trading on both sides of unchanged today. What is going on in this market to cause all that confusion?
Sure, and I'll start by saying the December contract, still the front month in cattle. The highs made last week with that big reversal session, those highs are still being respected. So, that is still where the majority of open interest and volume is, and those highs are still intact. But really, the bottom line right now is that we had a error in the USDA's new camera grading technology, and over the last several months, they overgraded a lot of beef, and so that left packers with a short supply of the high-quality beef that they really thought they had going into the peak holiday demand season. So, if the camera grades the beef at a higher quality than it really should have been graded at, then that left some higher premiums to the producers, but it left the packers scrambling. So now we've had the packers paying up for animals here to fulfill those needs that they have, and that's what I think the market's really trying to figure out right now is how much of a hole is still left to be filled. So we didn't have that scramble after the settlement prices on Friday on the cash side of things like we did the week prior. So maybe that suggests that they, at least during business hours, got enough done. But, we're watching the technical signals right now, and that may be the first place to look to really tell us whether this market's peaked out or not.
Is that why when we look at our beef cutout values, we have seen the choice cuts gaining on selects almost every day?
Yeah, I think that's definitely a big part of it.
Okay, so last Friday we had the choice cuts actually gaining 49 cents while the selects were down 8 cents. So just to kind of point out that spread relationship between those two, that seems to be ongoing there. All right, let's run down the live cattle and feeder cattle market for everybody. Here we go with a look at our live quotes. We have the December live cattle now 75 lower at 126.55. We've been on both sides of unchanged in these markets today. February 53 lower at 131.22. On the feeder cattle side, we have the January now down 47 at 161.05. And we have March down 40 at 157.95 per hundredweight. Let's take a look at that lean hog trade. Right now in the lean hogs, you have December down 38 at 64.72. However, you have February 12 higher at 72.10. April down one tick at 75.42. So what's going on in the lean hogs? They seem very confused today.
Right, yeah, like you had mentioned, you have some months higher, some months lower, so we're definitely seeing some spreading between months. Looking at the front month contract in December, we have been in a very nice uptrend since the lows made late September. It looks like we have today violated that uptrend, and we're sitting in an area that I think is pretty important. There's several trend lines in this December contract that are converging in the 64.75 area, and Friday's low is 64.77. So if this market does close below the uptrend that we've been in for the last couple months here, market's gotten very overbought, and I do think we have some potential downside for this December contract. The question would be, with the index sitting, about $4.50 above where the December contract sits, will we see the index start to come down? I did a little research on where the front month versus the index lies, and a lot of times you can see as much as a $10 difference between the front month contract and the index, so it doesn't always have to run lockstep.
Unfortunately, we'll have to leave it there. But Brian, thanks for all the insight in the markets. Boy, I covered a lot of ground. BrianSplitt of Allendale Incorporated, and off we go, Mark.
Absolutely. Good explanation there. Appreciate that.